Welcome to our investing series. If you're new to investing, this video is a great place to start. Investing is an essential tool for building wealth and securing your financial future. Let's embark on a journey into the world of investing. It's a universe filled with opportunities, challenges, and yes, a bit of risk. But fear not, for with risk comes the potential for reward. So, what is investing? In its simplest form, investing is laying out money today with the expectation of receiving more money in the future. It's about making your money work for you, instead of you working for your money. It's about planting seeds today and reaping the fruits of your labor tomorrow. Why is investing important? Well, we all dream of a secure financial future, don't we? Investing is the vehicle that can drive you towards that dream. It's not just about stashing money away in a bank account, it's about growing that money, making it multiply, and building wealth over time. But investing isn't a one-size-fits-all solution. It's a journey that's unique to each person. It's a journey that requires understanding, planning, and making informed decisions. We're going to talk about three fundamental concepts in this journey: risk and return, the time value of money, and different investment vehicles. Risk and return are two sides of the same coin. Investing always involves some level of risk, but it also offers the potential for returns. The key is to understand the relationship between risk and return and to find a balance that works for you. The time value of money is a simple but powerful concept. Money today is worth more than the same amount in the future. This is because you can invest your money and earn returns over time, making it grow in value. And finally, we'll explore different investment vehicles. These are the tools you can use to invest your money. They include stocks, bonds, mutual funds, and exchange-traded funds, each with its unique features and benefits. In this video, we'll cover the basics of investing, including risk and return, the time value of money, and different investment vehicles. That's where we're headed. So, buckle up and let's get this journey started. Investing always involves some level of risk, but it also offers the potential for returns. This is a fundamental truth in the world of investing. To navigate this landscape, it's essential to understand the relationship between risk and return. Risk, in the context of investing, refers to the probability that the actual return on an investment will be different than expected. This could mean that you could end up with less money than you initially invested. On the flip side, return is the money you make on an investment. It could be in the form of interest, dividends, or increased value of the investment itself. These two elements, risk and return, are inherently linked. Generally, the higher the potential return, the higher the risk. This is often referred to as the risk-return trade-off. For instance, stocks have the potential for high returns, but they also come with high risk, as their value can fluctuate dramatically. On the other hand, a government bond offers lower returns, but the risk is lower too, as it's backed by the government. Now you might be wondering, how much risk should I take on? This is where the concept of risk tolerance comes into play. Risk tolerance is the degree of variability in investment returns that an investor is willing to withstand. Your risk tolerance depends on several factors, including your financial goals, timeline, and personal comfort with uncertainty. Some investors are risk-averse, meaning they prefer investments with lower returns and lower risk. Others are risk-tolerant, willing to take on more risk for the chance of higher returns. Most people fall somewhere in between, seeking a balance of risk and return that aligns with their goals and comfort level. Remember, there's no one-size-fits-all approach to balancing risk and return. It's a personal decision based on your individual circumstances and goals. So, take the time to assess your risk tolerance and financial objectives. The key is to understand the relationship between risk and return, and to find a balance that works for you. By grasping this, you'll be well on your way to making informed investment decisions. Next, we'll talk about the time value of money. Now, this might sound like a complex financial jargon, but it's actually quite simple. The time value of money is a principle that addresses the potential earning capacity of money. It's the idea that a dollar today is worth more than the same dollar in the future. Why, you ask? Well, let's imagine you have a dollar right now. You could, in theory, invest that dollar and earn a return on it, making it worth more in the future. If you wait to receive that dollar in the future, you miss out on potential earnings you could have made from investing it. This principle is crucial to understanding investing. It's the reason why we invest in the first place, to grow our money over time. You see, when you invest your money, it works for you, earning more money even as you sleep, eat, or play. It's like having a little army of dollar bills marching out each day to bring back more dollars. Now, let's apply this concept to a real-world scenario. Say you're given a choice between receiving $1,000 today or $1,000 5 years from now. According to the time value of money, you should choose the money today. Why? Because you can invest that $1,000 and over 5 years, it could grow to be worth more than $1,000. Of course, the rate at which your money grows depends on the rate of return you earn on your investments. That's where things like interest rates, inflation, and risk come into play. But we'll delve into those topics another time. For now, remember this. The earlier you start investing, the more time your money has to grow. It's not just about how much you invest, but when you start investing. This concept is simple, but powerful. Money today is worth more than money in the future. That's because you can invest your money and earn returns over time, making it grow in value. Now, we'll explore different investment vehicles. These are the tools you can use to navigate the financial seas and reach your wealth-building destination. They come in many shapes and sizes, each with its own set of potential rewards and risks. First, let's talk about stocks, also known as equities. When you purchase a stock, you're essentially buying a small piece of a company. You become a shareholder with a stake in the company's success. If the company does well, the price of the stock increases, and you could sell your shares for a profit. But if the company doesn't perform as expected, the stock price could decline, and you could lose money. Remember, investing in individual stocks can be risky, so it's crucial to do your own research and consider diversifying your portfolio. Next, we have bonds. Unlike stocks, bonds are debt securities. When you buy a bond, you're essentially lending money to an entity, like a government or corporation, for a set period. In return, they promise to pay you back the loan with interest. Bonds are generally considered less risky than stocks, but they also typically offer lower returns. Then we have mutual funds and exchange-traded funds, or ETFs. These are collections of stocks, bonds, and other assets managed by professionals. When you invest in a mutual fund or ETF, you're pooling your money with other investors to buy a broad range of assets. This diversification can help spread out risk. But remember, these funds come with their own set of fees and expenses. And let's not forget about real estate, commodities, and other alternative investments. These can add further diversification to your portfolio, but they also come with their own unique set of risks and potential rewards. Remember, each investment vehicle has its own risk and return profile, and it's important to choose the ones that align with your financial goals and risk tolerance. Stocks, also known as equities, represent ownership in companies. Bonds are debt securities that offer regular income. Mutual funds and ETFs, exchange-traded funds, are investment vehicles that pool money from many investors to invest in a variety of assets. These are just a few of the basics, but understanding them is crucial for making informed investment decisions. We've journeyed through the fundamentals of investing today, starting with the relationship between risk and return. Remember, as potential returns increase, so does the level of risk. It's all about finding the right balance that aligns with your financial goals and risk tolerance. Then, we moved on to the time value of money, a simple yet powerful concept that underscores the importance of investing sooner rather than later. The idea is straightforward. Money available today is worth more than the same amount in the future due to its potential earning capacity. This is the foundation of the principle of compound interest, which allows your investments to grow over time. We also explored different investment vehicles, each with unique characteristics and benefits. Stocks or equities give you a share of ownership in a company, bonds provide regular income as debt securities, while mutual funds and exchange-traded funds pool resources from various investors to invest in a diverse range of assets. Investing can seem intimidating at first, but remember, every expert was once a beginner. The key is to start with a solid understanding of the basics, and then continue learning and adapting your strategy as you go along. As we continue our series, we'll delve deeper into these topics, providing you with the knowledge and tools to navigate the world of investing with confidence. Up next, we're going to dive into the world of stocks and equities. We'll explore what it means to own a piece of a company, how to evaluate a stock's performance, and strategies for incorporating stocks into your investment portfolio. Thank you for joining us on this journey to financial literacy and empowerment. We believe that with the right knowledge and tools, everyone can take control of their financial future. So stay tuned, keep learning, and remember, the best investment you can make is in yourself. In our next video, we'll dive deeper into stocks and equities. Thanks for watching, and we'll see you in the next video.